Hey guys, welcome back to Module 6, where we're going to be talking about operating assets, inventory, PP&E, property, plant, and equipment, and intangible assets. And really, how much should a company invest in its assets? So, in our previous modules, we spent a lot of time looking at revenue, expenses, receivables, profitability, and operating efficiency. But in this module, we're going to focus on another major managerial question. What resources does a company need to operate, and how effectively is management using those resources? For many businesses, a substantial amount of money is tied up in inventory, property, and equipment, and intangible assets. And those assets help generate revenue, but also require an investment. So, from a manager's perspective, more assets are not automatically better. The real question is, are these assets generating sufficient value for the business? So, inventory is an investment. It represents products a company intends to sell or resources that will eventually become products for sale. From an accounting perspective, inventory is an asset until it is sold. When inventory is sold, its costs move from the balance sheet to the income statement as the cost of goods sold. Remember the relationship we've already encountered. The beginning inventory plus your purchases minus your ending inventory gives you your cost of goods sold. But from a manager's perspective, inventory is more than an accounting number. It represents cash that has been invested in products that have not yet been sold. So too little inventory can create stockouts, lost sales, and unhappy customers. Too much inventory can create storage cost, obsolescence, markdowns, and cash flow problems. So inventory management is really a balancing act. One important issue is determining which inventory costs become cost of goods sold and which remain on the balance sheet. Two methods you'll encounter are FIFO and LIFO. FIFO means first in, first out. Under FIFO, the older inventory costs generally flow into cost of goods sold first, leaving the more recent cost in ending inventory. LIFO means last in, first out. Under LIFO, the more recent inventory costs generally flow into cost of goods sold first. Why does that matter? Because inventory costs are changing. FIFO and LIFO can produce different amounts of cost of goods sold in the inventory and reported profits. That's the big thing. You can play a lot of games of profitability based on LIFO and FIFO. So the way that you account for your inventory. So suppose inventory costs have been rising. Under FIFO, older and typical lower cost flow to cost of goods sold first. This generally produces a lower cost of goods sold and higher reported profit than LIFO. Under LIFO, newer and typically higher cost flow to cost of goods first, and it generally produces higher cost of goods sold and lower reported profits. That's important. The important point on it is that the company's underlying sales of activity can be identical while the accounting method affects the reported results. So looking at it from a manager's perspective, did performance really improve? Imagine two competing companies selling essentially the same products. One uses FIFO, the other LIFO. The FIFO company reports a higher gross margin, and can we immediately conclude that it is better managed? We can't. Part of the difference may simply be the result of the inventory accounting methods. That is why managers and analysts need to understand the accounting policies behind the numbers before comparing companies. A reported difference is not always an economic difference. Sometimes it is an accounting difference. For inventory turnover, this also connects directly to the efficiency analysis we began in Chapter 4. One important measure is inventory turnover. Conceptually, inventory turnover tells us how efficiently the company is moving the inventory through the business. We can also convert turnover into days inventory outstanding, DIO, and the Managerial interpretation matters more than simply calculating the ratio. Suppose DIO increases substantially. What might that mean? Perhaps management deliberately built inventory because it expects higher future demand. But perhaps products aren't selling, maybe customer preferences changed, and maybe the company has obsolete inventory. Or perhaps the supply chain concerns caused management to intentionally carry more safety stock. So once again, the ratio tells us what changed. Management has to determine why. Accounts payable. Inventory also connects to accounts payable. Companies frequently purchase inventory from suppliers on credit rather than paying for cash immediately. That creates an account payable, and we can analyze accounts payable using measures such as accounts payable turnover and days payable outstanding. A longer payment period may help the company preserve cash, but longer is not automatically better. If a company delays payments excessively, it could end up hurting those supplier relationships, losing discounts, or they could even be signaling financial difficulty. This connects directly back to the cash conversion cycle, and managers are balancing three important operating activities. How quickly can we sell inventory? How quickly can we collect from customers? And when do we have to pay suppliers? Those three questions have enormous implications for cash flow. For the fifth area here, the property, plant, and equipment. When we look at PP&E, property, plant, and equipment, these are the long-lived assets, such as buildings, machinery, equipment, and other physical resources used to operate the business. PP&E represents or presents managers with a different kind of investment decision. Suppose a company is considering spending about $100 million on a new manufacturing facility. That investment could increase capacity and support future growth. But the company is also committing a substantial amount of capital, so managers should ask, do we actually need the additional capacity? What return do we expect from the investment? Could we lease or outsource instead? And how quickly might technology become obsolete? Those are strategic questions, not merely accounting questions. When we talk about depreciation, once a company purchases a long-lived asset, the cost generally isn't expensed immediately. Instead, the asset is capitalized and its depreciable cost is allocated over its useful life through depreciation. So one distinction is extremely important. Depreciation is not intended to measure the decline in an asset's market value. It is an accounting process for allocating the asset's cost over the periods that benefit from its use. So management, therefore, has to make estimates about things such as useful life and residual value, what it's worth when you're ready to sell it at the end of its life. Those estimates affect the amount of depreciation expense recognized each period, and that means they can also affect reported earnings. Looking at it from a manager's perspective, suppose a company spends heavily on new factories and equipment. Total assets increase significantly. Is that good? Potentially. But the investment needs to produce results. This is where measures such as PP&E turnover become useful. The managerial question is, how much revenue are we generating from the productive assets we invested in? If PP&E increases substantially, but sales don't follow, management should investigate why. Perhaps the company is preparing for future growth. Perhaps the new facility isn't operating as efficiently as you'd like it yet. Or perhaps management is simply over invested. Again, the ratio begins the conversation. Intangible assets. Not all economically valuable assets are physical, and sometimes companies have intangible assets. Those include things such as patents or copyrights or trademarks, licenses, and other rights. And some intangible assets have finite useful lives. Those assets may be amortized, which is conceptually very similar to depreciation. Instead of allocating the cost of a physical asset over time, we're allocating the cost of an intangible asset. But not every intangible asset is treated the same way. And one particularly important intangible asset is goodwill. So, goodwill generally arises when one company acquires another company and pays more than the fair value of the identifiable net assets acquired. Why would a company pay more? Because the acquired company may actually have value associated with things such as its customer relationships, its brand, its workforce, reputation, business processes, or expected synergies. Under U.S. GAAP, goodwill is not routinely amortized like a finite lived intangible asset. Instead, it's evaluated for impairment. Conceptually, impairment asks, has the economic value associated with the asset declined enough that its reported carrying amount should be reduced? So, from a manager's perspective, what does a goodwill impairment tell us? Suppose a company acquired another business for about $5 billion and records substantial goodwill. 3 years later, it announces a major goodwill impairment. From a managerial perspective, that's worth investigating. It may indicate that the acquired business hasn't performed as expected, the expected synergies didn't materialize, industry conditions changed, or perhaps management simply paid too much for the acquisition. The impairment itself is an accounting event, but the business story behind the impairment is what should interest an MBA student. So, bringing these assets together, inventory, PP&E, and intangible assets look very different, but they share an important managerial characteristic. They represent resources in which the company has invested capital with the expectation of generating future benefits. Inventory should eventually generate sales, and PP&E should help the company produce goods or provide services. Intangible assets should help the company generate economic benefits. So when analyzing these assets, don't simply ask how much does the company own, ask how productively is the management using what it owns. Okay, so what I want you to know for Module 6, as you finish Module 6, you need to focus on these ideas. First, you need to understand the relationship among inventory, purchases, and cost of goods sold. Inventory remains an asset until it's sold, then it's cost of goods sold. Secondly, you need to understand the conceptual difference between FIFO and LIFO and recognize the inventory method can affect cost of goods sold, ending inventory, and reported profit when costs are changing. Third, you need to understand inventory turnover, days inventory outstanding, accounts payable turnover, and days payable outstanding as measures of operating efficiency and not just formulas. You also need to understand that PP&E represents a major capital investment and that depreciation allocates the cost of those productive assets over time. Fifth, you need to understand that asset turnover and PP&E turnover help us to evaluate how effectively management utilizes investment resources or invested resources. You also need to understand the differences between tangible and intangible assets, including the role of amortization, and also understand goodwill and impairment. So a goodwill impairment can tell us something important about whether an acquisition delivered the economic benefit management originally expected. But ultimately, the central manager perspective is what has management invested in these assets, and are those assets generating sufficient value for the business? That's the question I want you to carry forward with. And in Module 7, we'll move to the other side of the balance sheet and examine current and long-term liabilities. In other words, how companies finance some of these investments and obligations and risk that financing creates.